Good morning, everyone. Steve Ankerstar here, and we are coming to you live from New York City, which you can see in the background. That's a real picture. That's not fake. Obviously, if it were a fake picture, it wouldn't have these big window crosses behind me. But I'm coming to you live from the 46th floor of a pretty cool hotel downtown New York City in mid-Manhattan, right by the Rockefeller Center and right next to JP Morgan headquarters. So I was toying with it. You know, I like to watch Saturday Night Live, and I do make some Saturday Night Live references on occasion. And I was thinking about a cold open this morning where, I'm like, live from New York, it's Thursday morning, and then kind of bailed on that. But, all the humor aside, I'm up here for a conference. I'll tell you about that more in a minute. But let's talk about what we're going to talk about today. First of all, why am I in New York City? And what am I learning while I'm here? And what can I in turn teach you from what I learned while I'm out here? Secondly, big announcement today, especially for those that are either collecting Social Security or about to, or those of us who have a military pension, is the Social Security cost of living adjustment is going to be announced here in about an hour. I'm looking over at CNBC. I think about an hour is when that's going to come out. I'll make the call. I think it's going to be 8.9%. It's either going to be high eights or low nines, that sort of thing. We'll talk about that and how that affects you and whether or not it affects claiming strategies. And the third thing we're going to talk about today is the whole reason why I'm here is this index fund conference, difference between an ETF and a mutual fund. You know that you've heard me say stuff before, and then yesterday we show up and, one of the individuals stands up there and says, first of all, let's cover the difference between an ETF and a mutual fund. Well, there's, 100 asset managers in the room like myself. And but every time I hear it, I kind of like, I know all this. Every time I hear it, I learn something new. So therefore, I'm going to pass that on to you today. All right. So before we get started, though, remember this is a financial education presentation. You have to do your own due diligence before acting upon anything you hear in this presentation. More disclosure information is available at ankerstarwealth.com. Now let's get started. Okay, let's take a look at the market futures since we happen to be right here anyway. Futures are in the green. Why? Hope. There's certainly nothing data dependent that with the futures being the green, but we do have more inflation data rolling in today. The hope is that inflation is going to break. And when that's the case, it was 57 minutes there. You can see that in the live feed there. But yeah, the hope is the market's going to turn around and go higher. I would say that's unfounded hope. I would not be looking to think today is the day that we bottom out. So we shall see, though, what that inflation holds. All right, let's talk about the symposium. So I'm in New York City. I was invited by my contacts in Austin, or that manage the Austin area. Jason and Jimmy, thank you for the invite up here. But they approached me and they said, Steve, once a year we have a conference where we bring everybody up to JP Morgan headquarters. We have them talk to our all-star team leadership. I've not yet, if you heard my briefing on Tuesday night, my quarterly IAB, I've not met Mr. Diamond yet. I do not think that's on the agenda today. I look through here. It doesn't say Mr. Diamond's going to come down and meet Steve. So I don't think that's going to happen. But we are talking with some folks that are fairly high up in the JP Morgan chain. And that's the purpose. They're telling us, what's going on in the ETF space, what new what products are working now, where are places to allocate money to when the 60-40 portfolio that you've heard me talk about is basically broken. Everything's going down. So in an environment like that, which we've been dealing with for, the bear market strategy ever since the first quarter of this year, we're looking at protecting capital, right? We're looking at losing less. You've heard me talk about cash is an option if you want that. Otherwise, it's simply let's lose less during this downturn, protect that capital for you, and then look to catch the snapback. When is that going to be? Well, that's the $1 million question, right? Or billion or trillion or zillion or whatever you want to put. But we don't know when the snapback's going to be. We had hoped that it would be early 23, maybe late 23. Some folks are saying off in 2024. It's not knowable. However, we're going to preserve capital the best we can. What are the places to do that? So you can kind of see the agenda here. Again, not really looking to push any particular specifics. But I will say, to hear the insight from the industry and the folks, the experts here, is really pretty telling as to what everybody thinks is going to happen with the inflation problem that we have. The Fed rate hikes, pretty much the 75 basis point rate hike next time around is pretty much baked in now, especially after the Fed meeting minutes yesterday. And then how to, all of us as an industry, how can we protect capital the best we can? So really good stuff. That was yesterday. Again, flew in yesterday morning. They treated us, royal treatment. Thank you, thank you, thank you. That's always nice, not necessary. It's always nice. And to be able to just sit around a table and talk with experts in the industry. Here's today's agenda. Back on the road on an airplane out this afternoon back home. So a great opportunity for me to not only learn from the folks at JP Morgan, but also just to meet other folks out in the industry, including a few from Austin that I now have contacts that I can utilize when I have questions and things in the Austin area. So overall, great experience. All right, second topic. Let's talk about the Social Security COLA, highest in 40 years. And everybody's like, yeah, right, if you're collecting Social Security. Well, this is not this year's headline. This is last year's headline. But it will be in an hour this year's headline too, because it's going to be higher than last year. So you can see there 5.9% last year. Again, like I said in the open, it's the high 8s to the low 9s. I'll say 8.9. I don't have any particular insight there. I'm just saying that's my call. We'll see here shortly, but right around that 9% or so in bump up. You can run your own math as to how that affects you personally, but it affects everybody. It helps everybody out that is either living off of Social Security or collecting it. Either way, the money's the same, right? But the overall putting more money out there in the folks that need it, that have paid into the system for years. So set aside your personal opinions of Social Security and whether we should or shouldn't, blah, 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 or the political aspects of it. None of that. It's getting more money out into the economy, which is, helpful. Now, may not help the inflation problem, but it helps people, live and survive in retirement, especially if we're going into a recessionary period. So does this affect your claiming strategy if you're one of the handful of folks that are kind of straddling that, hey, I'm about to be 62 and I'm starting to have some options. Do I hurry up and claim to take advantage of this? Because the COLA that's announced today doesn't take effect until January 1st of 2023. And no, sir, no, ma'am, do not change your claiming strategy based on the COLA, right? It'll be there, right? You don't have to do anything fancy to get it, right? So do your math for your situation. Talk to somebody if you need to. Call me or my team. We can work it through it with you. But overall, there's not a decision to be made there. Now, if you're in the military, it's a little bit different because if you're not retired, you don't get this. You get the military pay rate increase, but anyhow, that's a specific situation. So I won't go into any detail there. But I will say this: with 5.9% last year, and then probably 8, 9, or 9 this year, and 5 next year, overall, that's a pretty big move up. So you already know that Social Security is a little bit in trouble when the actuaries sit down and talk about, how long will the money last, right? Because that's a great question. So there are going to be changes coming in Social Security. If you're really close to claiming, I'm 53, I don't think it'll even affect me. But certainly if you're younger, I think you're going to see some pretty major differences in the math that goes into it. They can withhold, they can increase the, they can move the ages again more to the right, more reflective of us living longer. That's one thing that will probably happen. They might pay a little bit less. That will probably happen. They will probably increase Social Security taxes on, that limit where you don't have to pay any more in. They'll probably move that higher. So it's probably gonna be a combination of all those things, but don't sweat it. The government eventually will figure it out. Nobody likes to touch it, but when it comes around to the agenda and they have to make a move, they'll make a move and we'll move on from there. Okay, last thing I want to talk to you about, what is the difference between an index fund and an ETF? Again, this is Investopedia. This is written intentionally at an 8th grade reading level, which I like because I can explain it to you. And, you can at least understand all the words, if not what they mean, right? So it's a good place to go for kind of the basic explanation. It's not super in depth. So, you have to seek out a little more advanced stuff, but basically, the key takeaways here, mutual funds are pooled investment vehicles. They've been around for a long time. There's a money manager at the top of it or a team, and there's a fee that goes with it. And the fee generally, historically has been pretty high because, expertise you have to pay for. I'm in that business too. If you're a client with me, you're paying for my expertise and paying for the team's expertise and everything we can bring to you. But in a mutual fund situation where they're building a portfolio of securities and then managing those securities, along comes the exchange traded fund, which is the same thing, but it's more efficient. Right. So mutual funds trade once a day at the end of the day. So if you've ever, tried to sell one, you put your order in, you hit enter, and you're looking at your E-Trade like, what's the matter with this thing? It didn't sell. It doesn't sell till the end of the day. Where if your ETFs out there, just pick like cyber from first try. I'm JP Morgan folks, JPST, right? If you want to sell your JPST, you click it and boom. And as soon as you sell, it's like, yep, order complete. And you look down there and it says 0 and the position's gone and there's your cash and life is good. And you go off and buy something else or sit in cash, whatever you want to do. However, with the mutual fund, no, you put the order in, you don't get the cash till the next day, right? And if the market's crashing at 10 a.m., if you're like, hey, nuclear war is breaking out, that we talked about that the other day, that'd obviously be a horrific situation on a lot of levels, including financial. Your money's not going to sell. It's not going to go till the end of the day. So if the market's going to crash another 10%, you just eat all of that because you've got no other recourse. However, in an ETF, you simply sell it and you're done at that millisecond that the trade executes. So tax efficiency, I will just say that the whole design of the index fund is to when people buy more into it, they buy those securities and, it all happens. I will say electronically. Obviously, there's got to be a human monitoring it in there, somewhere. So it's not like robots gone wild, but it happens very quickly and reprices. And by doing in-kind exchanges with these securities, you're not getting that capital gain that you get with a mutual fund. So let's talk about that. And that's the one thing that pissed me off about mutual funds and why I left them back in the day is it was one of the down years. I think it was 2000. And I had a mutual fund and I'm down, that was the tech crash. So I'm down, probably USA Cornerstone or Janus 20, I think was my favorite. Like, man, I love that fund, made all kinds of money, but tech crash, it's going down. And so I'm down for the year and I'm like, I can handle that. I'm mature. I'm not like 5 years old. Right. So it's like, okay, I'm down. But then on like 28th of December, I get this huge capital gain payout and I owed taxes on all that. So again, when you pull money into a mutual fund and you hold it for you have years of gains, and then the other people, and you've heard me like to say, none of us is as dumb as all of us. Well, when the other people start taking their money out, then the mutual fund management team has to start selling shares, and that generates a capital gain. And then they pass it on to who? That's right, the suckers that are still there. So I did not like that at all. And that still exists. I was helping a client not too long ago that has a very sizable position and in a taxable account, and they got hit with a sizable taxable gain. If you have that happen to you, call me. It's called an opportunity zone. We can work through it, but and save you on those taxes. But if you're not eligible or not interested in that, you're just going to eat some taxes. And I hated that. So I'll conclude with this. The ETF index funds are the future. I'm not here to make a play or pass judgment today on passive versus active. Passive, you simply buy the SPY. Active, cyber, or JPST, where you have a manager in there, actively working the situation. That's not the topic of the day. Topic of the day is these things are very efficient. They are relatively cheap compared to mutual funds. And the one thing I didn't know so always need to teach you something, right? So if you've listened to every word I've ever said, which, good on you if you have, but the industry is actually finding that they're making more money. Not that it's about them making money, but they do need to make money to provide this expertise, that the ETF can actually be more profitable, even though it's cheaper. So it's win-win, right? So you, the consumer, are paying less, but the owner of that index fund can actually make more because they don't need the whole team of people to be able to manage the fund. So it's efficient all the way around. Efficient for the consumer because you're paying less for pretty much the same thing. And it's efficient for the administrators because they won't need as many, it's not as capital intensive, if you will, or human capital intensive. Okay, obviously my voice is given out, and I need to head on over to JPM headquarters to continue on. But let me just leave you with this. Learning lots of information this week in a fantastic place. So very motivational. I will have more for you tomorrow morning when we're back in Austin with our show. Allison will be back there tomorrow morning as well. Not in Austin, but she'll be back on the show tomorrow morning. It was too early for her today. So then thanks again for listening in. Hope you learned something today. We'll get inflation data here shortly and that Social Security COLA, and then we'll talk about that tomorrow. So thanks again for your questions. Keep them coming, and we'll talk to you back tomorrow morning. Bye.